So, whenever you go to the racetrack, you spend a nice day and then you get to the seventh race. Or when you go to the prize fights, you wait for the feature attraction. And when we decided to come to Berlin, in my mind's eye, a discussion of the future of Europe was the feature attraction. We have an outstanding panel here, and will be led by a moderator, Wolfgang Munchau, who I can speak personally has done as much or more to illuminate the questions and the challenges and the unfolding politics of Europe as anyone I know. Wolfgang has a wonderful newsletter, Eurointelligence, and he's been a great journalist with the Financial Times and has been a very, very courageous member of the German community, and I think we all should be very grateful that you're going to lead our session. Wolfgang?
Well, thank you very much for the kind words. We had, I was reminded, almost an identical session a year ago at Bretton Woods, also the future of the Eurozone, and obviously we have the same today, and I would bet that we'll have one in 2013 as well. We have a different panel, except Wendy, who stepped in for Giulio Tremonti. She was on the panel with me at Bretton Woods last year, and several members of the audience were also there on the panel with me. So it is essentially a continuing discussion. Back then, the Eurozone crisis seemed to be a little better. There was a bit more optimism out there, not exactly on our panel, but out in the world, certainly here in the Eurozone itself. It was the time, April 2011, the European Stability Mechanism had just been agreed. The troubles of last summer had not yet started. The spreads in bond markets were relatively low, certainly low for the countries Spain, Italy. They were high for Portugal, Ireland, and Greece. But at the time, it was at least perceived to be a crisis of a very small country, very far away from Berlin. That has changed. We now have the crisis, as you know, became acute in the summer of last year, became more acute in November and December of last year, and with the European Central Bank, it seemed to get better. And one of the statements you heard, especially in this city, was that the worst of the crisis was over. This was a statement repeated frequently by senior officials in the government. We even heard the statement that we don't need a big rescue umbrella since the market pressure has eased anyway. So basically, crisis over mentality. Now we know that this is this optimism. We've had several periods of optimism before, but this period of optimism has ended. We're now in a position where Spanish spreads have returned almost to the level of November, and where intelligent commentators are now predicting that Spain might be the next country to enter into the European Stability Mechanism. It's a sentiment I share. So we're going to have many more phases of this crisis that are, I'm not sure, acute. My colleague Martin Wolf said we have moved from acute to chronic. That is perhaps a fitting description. Or George Soros said we moved from acute to lethal, or from unstable to lethal. This is a more lethal phase, as he put it. So George will tell us more about his vision in our discussion. So without further ado, I would hand on to our panelists. I won't introduce them individually as you have all their bios in your conference papers. I would like to ask the panelists to stick to 20 minutes, because if we do 25 minutes each, we won't have any discussion left. If we do 30 minutes each, we won't have any discussion and no dinner. So let's stick with 20 minutes most. It gives us half an hour of discussion later. That would be sufficient. I'll start with Markus.
Thanks a lot for the invitation. It's a great place to be here back in Berlin. I would like to talk about the euro crisis and also particular bond proposal. So let me give you an overview first. I first would like to raise two issues about the run-up of the crisis to give you a perspective what happened before the crisis. And I also raise two aspects for the crisis diagnosis. And then go to crisis management, what was done so far, and then say, what can we do for the new European architecture? Because you also have to think ahead, how will the new European architecture look like? And the Eurobond will come at some form, and we have to design it now. Think what is the best design of a certain bond structure in Europe, whether it's a Eurobond or some other bond structure. How much fiscal union we want to have, when, and do we want to keep the flexibility to go to deeper fiscal union later on? If we go for a Eurobond structure, we might be forced to go fairly fast. So let me just raise two issues before the crisis, and which are striking issues is that the inflation actually was really very different across the different regions in Europe, and this was very persistent. In the US, you also have the case that certain regions have higher inflation than other regions, but it's a different region every year. Here in Europe, it was over 10 years very persistent, and a gap opened up. When you look here at the graph I started at the beginning of the euro, that's the inflation index. You see that in Germany, inflation was much lower compared to other countries, and this gap somehow is open up, and one has to say it has to close down somehow. The second issue I want to raise is that what you see is the capital outflows out of Germany started actually in 2003, and the question is, what caused in 2003 these huge capital outflows? And of course, there was inflow into Spain, Greece, Italy, and so forth. Of course, in proportion, these are total amounts. In proportion of GDP for Greece, the number is much higher. But what happened in 2003? There's some speculation it was due to different regulation of Landesbanken, but that's still an open issue. If you look at the GDP growth, if you take accumulated GDP growth, it is the case that actually Spain was growing way, way faster than Germany. Germany was actually laggard in Europe. The black line here is the average in Europe. That's GDP growth accumulated. And if you add to it Ireland or Greece, you see even after the crisis, if you take as a base, let's say 95, they're way better off than Germany is. Okay, so you start from a different base. So if you think about huge transfers, you keep in mind that it is actually not the case that Germany was growing in the last 15 years tremendously. Other countries were growing much more dramatically. So what's about the diagnosis? And I want to mention two things. One is this diabolic loop that also came up earlier in the talk between the sovereign risk and the banking risk. What you have, if the sovereign gets more risky, the banks in Europe hold a lot of the sovereign risk. They get in trouble. They cut back their loans to the real economy. The real economy slows down, and with it the tax revenue, which then hurts the sovereign. And this loop is going on. On top of it, the banks might get so much in troubles that they have to be bailed out, which brings, again, the sovereign in difficulties. So you have these two loops, this diabolic loop between banking risk and financial risk, and it doesn't really matter where it starts, whether it starts in the banking sector or whether it starts in the financial sector. And the focus here in regulation or anywhere in Europe was very much on the fiscal side. I think the banking side doesn't get the same attention as the fiscal side. If you look at fiscal compact and all these things, it's all on the fiscal side. It's a story of Greece, Portugal, but there's not so much focus on the banking side, and I think the focus has to shift a little bit. A second thing is you have this diabolic loop, and the second thing is this flight to safety. You have huge capital flows. In good times, in the 2000s, you have huge capital flows out of Germany. Now you have huge capital flows back to Germany. So you have always these huge capital flows across borders. And the question is there any way to redirect these capital flows, which are inefficient, instead of moving across borders to move across other boundaries, but not across physical borders, and switch off these distortions which come with it? So right now, of course, the German Bund is appreciating quite a bit. The yield is going down, and the Italian, Spanish government papers are depreciating. And that's a clear sign of flight to safety. You can see as the German yield is going down last summer, the CDS spread is going up. So typically you might say if an asset gets more risky, its yield should go up, but it moves in the opposite direction. It's relative to the other countries, it's less risky. That's a clear sign of flight to safety. The question is, how can we make sure that we can switch off this flight to safety? What structure do we need in the bond market in order to control this flight to safety aspect? Now let me go to the crisis management aspects. So first we have some flow problems. We have to somehow keep the new debt under control, but we also have to make sure that growth is coming, and any structural reform might in the long run cause way more growth, but we know in the short run it causes a lot of uncertainty and disruptions, and this hurts domestic demand, and with it, it leads in the short run to lower growth. So one has to be quite careful how to implement some structural reforms. And the second problem, you have some stock problems. Who should actually, how do you want to resolve the debt overhang, and who should absorb the losses? Who is eating the losses? And of course, there's a lot of controversy who should read it, and there's a lot of disagreement, and that slows down the economy too. So what are these losses? Who should absorb these losses? You can think of temporary losses or permanent losses. If it's temporary losses, that's the task of the central bank liquidity problems. That's typically what a lender of last resort is for. But if it's a permanent loss, you can say, okay, this has to be done. The banks have to, they cost these things, so they have to, the shareholders have to absorb it, or the junior bondholders even have to absorb it. They have got the premium, the risk premium over years, and haven't so far lost any penny on their investment. Or we pass it on to the taxpayer, or through inflation and financial depression, we pass it on to savers. That's again, closer to the central bank universe. Of course, which channel you choose depends very much which country is involved. Okay? For example, if it's a fiscal taxpayer who's absorbing the losses, if some banks in Spain are in trouble and the Spanish government has to bail it out, so it's a debtor's country which is in trouble. If it's inflation the way out, then it's the creditor's country, the guys who save a lot. You have claims against others who will suffer from these. So there is essentially a conflict. Which way you go will immediately lead to redistributions across Europe. And of course, there's huge of controversy which way to go, depending which interests you consider. Of course, one way is to say, okay, I just dilute current shareholders of the banks and force recapitalization. And that's actually the way many economists would have said that's the right way to go. You just force capital into these banks. And that's essentially the thing which was ruled out last fall. I think there were major decisions last fall taken with this discussion, how much we should recapitalize, the 6% capital rule, not a percentage rule, not a level rule. There was no effort to bring more equity in. So everybody's renationalizing, withdrawing, cutting off, giving credit to the real economy. That was a decision made last fall. So now we have the other two channels open. The question is who is eating these losses and this uncertainty, of course. As long as there's uncertainty, there won't be any new investment. This strangles growth. Now let me think of this new architecture. Finally, I think it's very important to keep two pillars. The two pillars is, on the one pillar is you have institutional political discipline, you have the fiscal compact, some fiscal boards or something, make sure that things change. You also would like to change norms. It's a very slow-moving things. And it's essentially another way of doing Maastricht a second time around, perhaps the right way around. But you should not overlook private debt. Just looking at the public debt, I think, is the wrong way. The second pillar is market discipline. We all know that markets are inefficient to some extent, but market still provides some discipline. Whenever the interest rate goes up, it drives politicians to do certain measures. And it typically it's better to have two pillars. When one fails, at least you have the other one. And I think it's very dangerous to just give up one of the two pillars. So how is it done when you introduce a new bond structure for Europe? And there are different strategies, and I would like to outline 3 strategies. The first one I call the Alexander Hamilton strategy. That's very much a deal where you say, we will take on some of your losses, some of your debt. You can refinance yourself more cheaply. That's great for you, huge transfers for you, but you lose your fiscal autonomy. Okay, you pass it on to Brussels. That's the deal. That's what Alexander Hamilton did in the US. And the question is, which deals are different proposals. I will go through the proposals like the German Council of Economic Experts, the Wise Man Redemption Fund proposal is actually the one which has the biggest transfers to certain countries. Italy would benefit big time from this way. Spain wouldn't, so the countries which have biggest debt to GDP ratio would benefit a big time. The second strategy is very similar. It's just an add-on. Is say, I have an Alexander Hamilton strategy plus a TINA strategy on top of it. That's very well known in Germany. It's like there's no alternative or fait accompli strategy. And say, I go for some Eurobonds, and Eurobonds have to come with some deep fiscal union. And if it's not accompanied by a strict fiscal union, there might be some problems down the road. But when there's a problem down the road, then we will be forced to do it. Okay. And this ties our hand down the road, but we just go, this way. Some people will be naive, go with it, and then we will be forced down the road to go even deeper. The other strategy is like the SB strategy I'm proposing, so I'm I must say I'm not unbiased here, of course. It's like you want to limit these economic distortions. Essentially, the flight to safe havens and this diabolic loop. So let me show this ASPIS strategy. So the idea is the following. You have a European debt agency which buys up the sovereign debt. Let's say up to 60% of GDP for each country. You take the average of the last 5 years' GDP numbers in order to avoid some procyclicality. And then you issue a senior bond, which we call the European Safe Bond, ASPIS, and a junior bond, European Junior Bond. And if you do this, if you have some estimates, the liquidity premium in normal times, so it's about 70 basis points. That's from US estimates. It's about 5 billion. So it's quite a sizable benefit you just get from this liquidity premium. So essentially, and what's important here is you don't need any joint liability. Okay, there is no issue that you have to change any treaties. You can do it next month. And I think speed is of essence. We can't just wait to go through ratifications across all the countries to do this. If you later on want to go to Eurobond, it's still open. You can just put some guarantee on the ASPIS bond, and there's no issue. Then you have essentially a Eurobond. It's just a more general structure, and you can introduce it very fast. So the idea here is, instead of having this flight to safety capital flows across borders, you will have it from the junior bond to the senior bond. What's interesting about this is that both of these bonds are European bonds. So you have a flight to safety from a European issue to another European issue. So you don't have the distortions across border lines which you have right now. Even if there are distortions, if you look at this European debt agency's asset side, it will be that the Italian papers will depreciate in value, but the German papers will appreciate. So there's a negative correlation on the asset side which stabilizes the system. So that's the whole idea here. You have, when there's a time to crisis, so the ASPIS bonds, the senior bonds will expand, while the junior bonds will go down, but you have always flight to safety across these two bonds, across two European entities, and you switch off the flight to safety component across borders. And by doing so, you stabilize it. So what's my wish list for such a new bond structure? And I think the ASPIS satisfy many of them, and I will go through alternative proposals. I would like to preserve market discipline on top of political discipline. I think we need both. Just giving up one is not enough. I would like to create a European safe harbor asset. We need such a European safe harbor asset. The German Bund is too small. It's also for one country. It's not a fair distribution. And a safe harbor asset doesn't need to be big. We see from Swiss government papers, they're also a safe harbor. But if it's small, it creates problems because it causes huge price movements. If they fly to safety, the price moves around very dramatically. If it's large, the price movements are less dramatic, it's more stabilizing, and the benefit for the country which issues this, in Europe in this case, is much bigger. So it would rival the US Treasury in this case. And as I mentioned, it should redirect the flight to safety capital flow. You want to break this diabolic loop between sovereign risk and banking risk. And you want to preserve the flexibility to what extent you want to go in the fiscal union. You want to bring the people along with you to create a fiscal union. You don't want to just be forced again by your hands, what we did with the European Monetary Union. You go ahead, and then later you will be in trouble, and then we have to do another step. That's one strategy. Perhaps that's the only politically feasible strategy, but why don't a structure which allows you to go step by step with the people and bring the people on board? It should be a structure which you can introduce soon, and it should be a low-risk strategy, something which you can reverse at any moment. So if it doesn't work, you switch it off, and it shouldn't be costly to switch it off. So here's my comparison of the different proposals, and the first column is essentially just all the wish list I mentioned before. There's the ASPIS, we're pretty much satisfying all of that. And you can scale it up, you can make a Eurobond later on out of that. The Eurobond the classic Eurobond doesn't have the market discipline. You would just switch it off. The blue-red bond would have it to some extent, but not so much. There are some distortions which are very detailed, I can go into that. There's an alternative proposal which is like a Eurobond for short-term paper, Euro bills, where to own everything up to 1 year and up to 10% of GDP can be issued. And this proposal essentially leads also to a safe asset, but the asset is very small. So it leads to swings in the yield curve. Because everything is short is safe, and if there's flight to safety, it will move from long-term paper to short-term paper. You have swings in the yield curve. And then there's a Council of Economic Experts in Germany, the Sachverständigenrat, who has this redemption fund, which has a limited market discipline. It has strong features to get the debt level down, very strong incentives to get the debt level down, but essentially it doesn't provide a safe asset in the long run. In the long run, you would like to have a market structure where the banks can invest in safe assets which are truly safe, not other sovereign risk. I want to break this diabolic loop where the banks don't have to load on sovereign risk. So let me sum up. So here's what I wanted to propose. So we really have to create a European safe harbor asset. There are different ways to do it, and it will come. There's no question it will come. It just will take some time, and we have to think about it, what's the best way to do it? How can we design it in a way to preserve incentives and make it in a way that the distortions are switched off? In particular, we want to isolate the banks from sovereign risk. The ECB's LTRO goes in the opposite direction. Banks will be loaded with more sovereign risk, and that's perhaps a short-term way of getting out of some troubles, but it doesn't really solve this diabolic loop. It makes it even worse. It's more a doubling down strategy. And I think SPs are also flexible and reversible. So if it doesn't work, you just switch it off. It allows you to gradually build the fiscal union as the strength grows within Europe. In the long run, we want to go to a more united Europe. And it's not the fait accompli or TINA strategy where you have forced your hand. And finally, I would like to say the focus in Germany in particular is very much on Greece. It's very much on fiscal compact, which is important on one hand, but private debt shouldn't be ignored as well. So bank regulation, a European FDIC, some bank restructuring regulation. At the European scale, you have a two-tier banking system, European banking system, then more national banks. This has to be all thought through, and I think it's very crucial to find a new structure to stabilize what's going on.
Thank you, Markus. Can I ask you a question before we go to the next panelist? You said there were no hidden transfers in your system, but surely there must be some transfers in such a system. Would they just be non-hidden transfers, transparent transfers, or how would you see the transfer mechanism working?
So in a sense, right now, there is actually a hidden transfer from the southern countries into Germany, because Germany can refinance itself at a very, very low rate. We would switch off these transfers. But on top of it, many of the other schemes have on top of it transfers in the other direction. So we would start the distortions which come with the current transfers would be switched off.
Okay. Could I move over to Wendy, please?